Hello again. Welcome back, and in this section, we will be focusing on risk management. To have a long-term positive expectancy in the world of trading, it is more important to know how to protect your money than it is to make the money in the first place. This can be done efficiently through having strong risk management and using the correct position sizing. To understand risk management, one must first understand risk to reward ratios. In essence, risk to reward refers to how much you are risking to lose on a trade versus how much you are standing to gain. This can be calculated using your take profit and stop loss. For instance, if a trader is looking at a setup where the current price of the asset is $100 and they are looking to enter at the current price with a price target of 110 and a stop loss at 95, then the trader would be standing to lose $5 if the stop loss is to hit and gain $10 if the take profit is to hit. If the trader has the potential to either lose $5 or gain $10 on that trade, then their risk to reward ratio would be 1 to 2, since for every dollar they are risking, they have the potential to gain 2. A 1 to 2 risk to reward ratio is actually extremely strong due to the fact that they only have to be correct about their conviction 1/3 of the time in order just to break even. Take a look at this chart here that has different risk to reward ratios and also shows the success rate needed to break even in the long term. Of course, if you have a success rate higher than the listed rate, then you will have a positive expectancy where you are looking to make gains in the long run. Likewise, if you have a success rate lower than the listed rate, then you will generally have a negative expectancy where you are looking to actually lose money in the long run. So for a trader to have a positive expectancy, their trading strategy has to have a higher success rate than the break-even rate for the risk to reward ratio that their trading plan follows. For instance, if we look at the first column that shows a risk to reward ratio of 1 to 0.5, which essentially means they are risking to lose $1 with the potential to gain 50 cents, then for this trader to have a positive expectancy, they will need to have a success rate of greater than 66.6%, which means that they have to win more than 2/3 of the time. So as you can see, a risk to reward ratio of 1 to 0.5 is very poor due to the fact that the trader has to have high accuracy in terms of being correct about the moves they are anticipating. As you move down the rows in the chart, you'll notice that traders need only a lower success rate to have a positive expectancy in the long run. Say if a trader has a risk to reward ratio of 1 to 4, this means that for every dollar they are risking, they are standing to gain 4. So to have a positive expectancy, the trader simply just needs to be correct about a trade over 20% of the time. However, it is important to note that with the more favorable risk to reward ratios, such as the 1 to 3 and 1 to 4 risk to reward ratios, it is far less likely that the price target will be hit before the stop loss. So the name of the game in this situation is to find a way to maximize your risk to reward ratio while having a relatively strong success rate. To identify a success rate for a strategy, a trader will need to backtest a strategy to get a strong understanding of how often the price target is met before the stop loss is reached. To backtest a strategy, simply scroll backward through the chart, look for the setup that the strategy follows, and count how many times the setup successfully hit the price target and divide that number by the total number of trades that you looked at. So if you are backtesting a strategy and look at 1,000 setups that the strategy follows and find that 612 of those setups successfully hit the price target without stopping out, then the success rate would be 612 divided by 1,000, which is equal to 0.612. This means that the success rate for that strategy is 61.2%. When calculating the success rate for a strategy, the more trades that you use to calculate the success rate, the more accurate that success rate will be in terms of how it will translate over in your actual trading. Basically, don't only look at 10 setups that describe your trading strategy and use the data from that to decide a win rate. Look to use a minimum of 100 objective setups and try to get as much data as possible to understand your win rate. But anyway, let us talk about how to identify the risk to reward ratio of a trade. Of course, if you are strictly using percentages, then you can divide the win side percentage by the lose side percentage to get your risk to reward ratio. This means that if you plan on taking profit when a position is 30% in the green, you can divide this percentage by the percentage you plan on stopping out at. So if your stop loss is at 10%, then you would divide 30 by 10, which equals 3, and your risk to reward ratio would be 1 to 3. Similarly, if your stop loss was, say, 12%, then your risk to reward ratio can be calculated by dividing 30 by 12, which is 2.5. So your risk to reward ratio would be 1 to 2.5. However, say you want to use the art of technical analysis to identify risk to reward through purely looking at the chart. Well, let's move to TradingView and see how you would calculate the risk to reward there. Okay, let's go ahead and talk about how to identify risk to reward ratios when you're using levels on TradingView. If we take a look at this setup here, and we're looking at, say, a retracement of this recent move, where we're seeing a reactionary bounce from the 0.618 to the 0.382 level, and say we have our stop loss at the 0.707 level, what you can do to identify your risk to reward ratios here is pull out prediction and measurements tools, click on short position since we are looking to play the short side. And basically what you want to do is you want to first click where you want to identify your entry, adjust your stop loss to the level where you are going to be stopping out at, and of course set your target to where you actually are going to be identifying and taking profit at. If we go ahead and look here, you'll see that you get a risk to reward ratio right here, and that gives you 2.55. And that's the equivalent of saying you have a risk to reward ratio of 1 to 2.55, which means that for every dollar that you are risking, you are standing to gain 2.55, which is the ideal risk to reward ratio that we are actually looking for. All right, so let's go ahead and take a look at another example of how to identify risk to reward ratios on the chart. If you're going to go ahead and identify a pattern like so, where this time we have, if we look at the trend lines, just a nice little rising wedge pattern, and we're looking for the breakout of the bottom end of the wedge, then you can go ahead and identify your entry point, whether that be with the breakout and breaking close beneath this trend line, or with the retracement to the 0.618 level. You can go ahead and just identify your entry point. So say if we were using the 0.618 level of the retracement as our entry point, we can go ahead and pull out our short position tool again, click on the point where you're identifying your entry at, set your stop loss. Say if we wanted to have our stop loss above the wedge pattern right here, we'll go ahead and put a little buffer there, drag the stop loss there, and say if we were using the low of the pattern as our take profit, we can then just drag to the low of where our target is going to be, and then we can get our risk to reward ratio. Here in this sense, we have a risk to reward ratio of 2.1, which means that for every dollar you're risking, you're standing to gain 2.1, which once again is greater than 2.0. And these are the risk to reward ratios that we are looking for. Definitely a cool tool that you guys can use. And let's go ahead and just take a look at one more example, this time of the upside. Let me go ahead and remove the drawings off the chart. Say if you're playing this reversal back to the upside where we have this wedge pattern right here. If I go ahead and just draw out some quick trend lines, and say you went ahead and this time you entered with the candlestick close on the outside of this upper trend line. This time, since we're playing the upside, you would want to click long position. Go ahead and if we say we entered with the candlestick close right here above the level, click on the point where you're identifying your entry at. Say if we wanted to set a stop loss with the new low, then we can go ahead and identify a stop loss here. And if we wanted to play the retracement this time to say the 0.618 level as a price target on the reversal, go from relative high to relative low right here. And if you have the first price target at the 0.382, that gives you a risk to reward ratio of 1.84, which of course means that for every dollar you're risking, you're standing to gain 1.84. And if you have your price target at the 0.618 level, you can have a risk to reward ratio of 3.59, which means that of course for every dollar you're risking, you're standing to gain $3.59. So that is how you can use this tool on TradingView to identify risk to reward ratios. And this would, of course, be the value of the second number in your risk to reward ratio. And this is the value of the reward. So the risk value is going to be 1. The reward value is this value right here. So this would be a 1 to 3.59 risk to reward ratio. Anyway, that'll do it for this video. In the next video, we'll talk about how to identify what position size you should use.